All right. So the final exam is Tuesday the 8th. That's been on our course schedule since the beginning of the semester. And the approach to the test I've already mentioned, but let me say it again just to eliminate any uncertainty. It's going to be similar to how we did both of the midterm exams, where a PDF will be available on Blackboard starting at 10:15 a.m. You can begin working on that, print it out if you have a printer. If you don't have a printer, then please just work on either a plain piece of paper or on engineering computation paper. You need to scan it and upload the file to Blackboard before 12:15. And so if you live someplace with unreliable internet, then you probably should take this exam someplace that has reliable internet, like the county library or McDonald's or I don't know. You can come to campus and take the exam if you like. There's plenty of space. It's very quiet around here recently. Okay, so that's the final exam. You already turned in the homework assignment, so you're done with that. The projects are graded, so you don't have that hanging over your head. It's just the test. Now today we're going to talk about taxes, and specifically we're going to discuss some different types of taxes and how government gets the money that it uses to spend on public works projects. And before we do that, I wanted to just point out that understanding how to use this equation table is pretty important. You know, the exam will be comprehensive in nature, and so the majority of a disproportionate share of the points will come from the more recent material, meaning lecture 30 and onward. But there will be questions going back to the very beginning of the semester. So the basics like how to calculate A based on P and that sort of thing. So I wanted to refresh the suggestion that you familiarize yourself with this equation table and how to calculate the factors. Because remember, there are some interest rates like 7.2% where we don't have a table for that. And so you couldn't use the table lookup method for some of the interest rate possibilities that exist. And in a case like that, you'd need to be able to use these equations. All right, now in Wednesday's class, we did a couple of concept questions just to highlight the idea that it's really important for you to not only be able to calculate things and plug and chug through equations, but also it's important for you to understand the underlying ideas and be able to explain them, because that's really what's durable in this course, is your understanding of the fundamental principles, because those things don't change. So let's go through a couple of concept questions that are very much like what you could expect to see on the final. So briefly explain the repeatability assumption. So what I hope a student response to that question would include is both what is the repeatability assumption, and when is it used, and why is it used. And so the repeatability assumption is the idea that in the future the cash flow diagram, when repeated, is going to have the same amounts. And so it's that you could buy the item again in the future for the same amount that you bought it the first time, and that the revenues it generates will also be the same. So that's the assumption behind the repeatability assumption, is that you can do those things. So when is it used? It's used when you're comparing two different alternatives that have a different useful life. And so repeating a cash flow cycle a certain number of times can be used until you have LCM, the least common multiple, and that both cash flows terminate in the same year. Because remember, you cannot compare most alternatives if they have a different number of years to their useful life. So that was the when is it used, and why is it used. I guess I just addressed that, is that it's not a correct comparison unless the duration of the study period is the same for all alternatives. Okay, so when you get a question like this, you need to think about, what are all the things that you can tell me to convince me that you remember what we talked about during the semester, and then looking specifically at what the question asks. And so if the repeatability assumption does not apply, how can two projects with different useful lives be compared? So what if you can't repeat? And so you're not going to do the LCM approach. What else could you do? to compare alternatives. And so I'll ask, maybe type in the chat box there or unmute your microphone. Can you think of other ways to compare alternatives if you're not going to repeat the cycles? Harry says contract services. That's exactly right. So contract services, remember, is the idea that what you'll do is you'll take the shorter alternative and you'll extend it to be as long as the longer alternative. And the way that you extend the shorter cash flow diagram is you assume I'm going to lease the equipment. And so you go out and rent whatever capital equipment you need to do the work, and then the two alternatives end at the same useful life. So Harry had it right with contract services. And what's the other way besides contract services? Early termination. Harry gets it again. Well done. Yeah, so early termination is, you're saying rather than extend the short cash flow diagram, you truncate the longer one. And so you would not hold the equipment of the longer duration alternative for as many years as you could. What you do is you'd find out what's its disposal value at the end of the number of years that coincides with the other alternative. So you take the long one and make it shorter. Very good. What's the main advantage of the ERR method compared to the IRR method of project analysis? Now, remember, I'm not asking you, this question does not ask, what does ERR stand for? And this question does not ask, what does IRR stand for? It's good if you say that, you know, that's a nice thing to include in your response, but that's not the essence of this question. The essence of the question isn't define those acronyms. And it's even not define what both of they are. What I'm asking here specifically, it's a comparison question. And so what is the advantage of the ERR compared to the IRR? And so the main advantage of the ERR method is it allows for what's called an external reinvestment rate. And that's the idea that the IRR assumes that all of the cash flow that's generated is reinvested back into the project and earning the same rate of return at which it was originally generated. And that's rarely true. There are only a handful of investments where you're going to take your income and put it right back in. You can do that with a savings account. You can do that with some businesses. But most businesses, the profits come out of a project and then go somewhere else that are compounding at a different rate of return than it was originally generated at. So the main advantage is you can have what's called an external reinvestment rate. Okay, what about this? Can somebody unmute or respond in the text area? Why is money now more valuable than money in the future? Inflation. You're not wrong. Due to inflation. Expand. Like, tell me more.
Like $1 now is worth more than $1 in the future because you don't know what the price of things in the future are going to be.
Okay, good. You're absolutely right that it has to do with the price of things in the future. And it's not even just that we don't know what the price is going to be. It's that almost always prices are getting higher in the future. And so there's both the uncertainty there, which is an issue, and then also it's the fact that in the future you're going to be able to buy less with the same amount of money. So money in the future has a lower purchasing power than money now. And if you used that phrase purchasing power in your answer to this question, I'd feel like a little, my heart would leap with joy because oh yeah, that's a really good phrase. I'm so glad they saw that and remembered it. All right. Identify one shortcoming with the B to C method. Anybody even remember what B and C stand for here? Seems like so long ago.
Benefit cost method.
That's exactly right. And so what's a shortcoming of that, Zachary? What's so bad about B to C? Or like what's a weakness or a difficulty? Anyone? Bueller? Shortcoming with the benefit cost method? What's tricky about it?
Because not all of the benefits can be measured monetarily.
Good. Exactly right. Kristen's got it, and Casey said virtually the same thing in text chat. It's that the costs, we can quantify costs easily enough with dollars, but when you are quantifying benefits and disbenefits, what you're having to do is you're converting like social and recreational and environmental concerns into a dollar effect. And so you're saying, well, the joy of a child as they play in a playground is worth $8 an hour. And waiting in traffic, that has a disbenefit cost of $19 an hour. And a reduction in air quality pollution, in air quality in a certain area. So yeah, one of the shortcomings of it is that we kind of have to extrapolate things into financial estimates that don't naturally fit in that category. So I'd say that's one of the shortcomings, and that weakness can be exploited sometimes. You know, like if a certain government agency wants to do a project, then they'll use the uncertainty surrounding how to put a dollar value on benefit, and they'll run with it. You know, they'll say, well, the recreational value of this new lake is $30,000 per person per year. And, you know, they'll just sometimes make ridiculous assumptions to justify things that they want to do. All right, so I hope that you're thinking through these concepts. And a good way to study for them is to flip through the notes. You know, the notes for the course, the PowerPoints that I've shared with you, those are all posted on Blackboard. So if you don't have them printed out, you can flip through them electronically and just refresh your memory of some of the keywords and the terms and the concepts. Now we're going to talk about taxes. And I bet everybody here has seen a Walmart receipt before, and you don't even really spend much time looking at it that closely, but there's this line where your tax is added on top of the prices that Walmart is already charging. And so when you walk through the store and you see a price on the shelf or on the item, you have to keep in the back of your mind, oh, the tax is going to be added on top of that. That's actually pretty unusual, the way we do it here in the United States. Most other countries have the tax built into the price that's shown on the item or on the shelf. And so your receipt will mention how much of the item went towards tax, but it won't always, you won't have to keep in your mind the idea of, well, plus there's going to be a little extra. You know, you're going to have less of people taking things off the cart because they'd underestimated the cost of tax. So you can see here, this is a receipt, I think, from Switzerland. And each of the, Switzerland, CHF. And so each of the items have the tax built in. And so the price at the end, the total, is just the sum of each of the individual items. And it's not some additional line item tax on top of it. And underneath the total, they'll say how much of the $54.50 went to the state tax. But just kind of an interesting difference. And we're going to be talking about a variety of different taxes that are collected. Sales tax is one that we see every day. And sales tax here in West Virginia is relatively low, although there are a couple of places which have much lower tax rates. If you think about people in Oregon or Montana not paying any sales tax at all, of course, you know, they usually make up for it with higher taxes on other things. But in West Virginia, our state tax about 6%. There are localities that also add on taxes. I think that this 6.37% is taking into account the combined average state and local. And so, you know, Huntington and Charleston, I think, have a 1% sales tax that goes on top of the state's 6 point something. And so they've done kind of a statewide average to get our 6.37 for that. Value-added taxes have been proposed as a way of avoiding many of the disadvantages that sales tax cause. And one of the disadvantages of a sales tax is that, number one, you could cross borders to avoid it. So think about people in Northern California or in Washington and how they might be tempted to drive into Oregon if they're going to do some electronic shopping or back to school shopping. You probably can't buy a car and get away with the tax avoidance because you end up registering a purchase like that. But there are other things where it maybe would be worth your while to avoid the tax by going to a different locality. So that's one of the disadvantages of a sales tax. The other is that the entire financial burden is borne by the end consumer. And so it's a little bit unfair that there's this whole chain of value, buying and selling, to get an item into the hands of the end user, but it's only the end user who ends up paying the tax on the production of that item. And so value-added tax, let me tell you a little bit about how it works, and then we'll talk more about the justification for it. Let's say that an area has a 10% value-added tax. The way it would work is that the first step in the supply chain would be a farmer who's going to grow cotton and sell it for $1. And so the farmer is going to get $1 from that sale, but the farmer has to collect $1.10. And the farmer would pass that 10 cents of the dollar purchase on to the government. And the next person, the textile maker, what they're going to sell is the clothes, the fabric that they make out of the cotton, and their sales price is $5. That's how much they get to keep. So that means that they would have to charge the next person in line $5.50 because it's 10% of what they are charging. So 50 cents would go to the government, but the textile maker only has to give 40 cents of that because they get a credit for how much value-added tax they previously paid. And so this is called value added because the tax is only applicable to how much value you add to the increasing the item's, I guess, value, for lack of a better word. The difference between $1 and $4, what this textile maker did was took some raw material and turned it into something more valuable. And so they increased the value of that thing by $4. And so 40 cents is how much net they give to the government because they get to deduct the previous VAT that they paid. So the next time, let's say that a clothes maker takes the raw fabric and makes a shirt out of it, so $12 as the selling price to the retailer. That means that with the 10% tax, so 10% would be $1.20, which means that they have to collect a total of $13.20. And so $1.20 is how much tax that they collected, but they previously had paid 50 cents, and so they get to keep that and only have to pay the government the 70 cents, which includes the added value between the previous $5 and the new $12. And so they added $7 worth of value in their step. And so you think about the retailer. You can see is adding $8 of value, going from 12 to 20. And so although the purchase price is 20, and that means that they have to collect $22 from the customer, they get reimbursed for the $1.20, and only $20 is going to the government. So each person is paying their share rather than the end consumer having to pay the full burden of that item. And so it's a little bit more fair because the government needs to collect money. We all recognize that. We want to have roads, we want to have schools, we want to have a national defense force and fire protection. I think there's a pretty good commonly accepted justification that government serves some pretty important purposes, and so we know that they need revenue. But this approach says that everyone should share the burden rather than it just being the end consumer. And so, everyone's profiting in step by step by step, and so everyone's contributing proportional to how much value they created in the chain. So it's a little bit more complicated than just charging one person, but it's certainly a lot more equitable. And so countries that are just kind of starting from scratch will more often go with a value-added tax rather than a simple sales tax. And one that comes to mind is I've mentioned, I think, a lot of times before that I used to live over in Dubai, and they only recently started collecting any tax at all. When I lived there the first time, there was no income tax, there was no sales tax, no property tax. There's just literally no tax. But now they've instituted a very small, modest value-added tax because it's sturdier against people avoiding the tax, and it's more fair. Gas taxes are a form of excise tax. So an excise tax is a special tax that applies just to certain categories of goods. And so like a fuel tax or a tax on cigarettes, those are examples of excise tax. And you can see that there's quite a difference, a spectrum on gas taxes across the country, as high as 58 cents a gallon in Pennsylvania. And I don't know what's the lowest, but one that I have some personal experience with is South Carolina. I frequently fly into North Carolina and then drive down into South Carolina. And so when I fly into Charlotte, I'll pick up a rental car, and I'm driving down the interstate, and I can see what the gas prices are. And as soon as you cross the state line from North Carolina to South Carolina, there's a big drop in fuel costs. It's almost about 20 cents because the gas tax in South Carolina is so much cheaper. So before I return the car to the airport, I always am sure to fill up the tank in South Carolina, and then I maybe top it off a little bit in Charlotte. But so gas taxes are important because they support roads, and the fees that are collected at the state level and the federal level are used to reimburse construction of highways and paving and pothole repair. And so if we want good condition roads, then excise taxes like this are a way of making sure that the people who use the roads are the ones that are contributing to its upkeep. Cigarette taxes are another form of excise tax, and it's also interesting to look at how these taxes vary from state to state. And I think they're probably all higher across the board than they were in 2018. I maybe ought to look for an updated slide, because I think that New York has raised theirs even further. $4.35 a pack, first in the country, with the highest cigarette taxes. And then places that traditionally have grown tobacco are a lot more tolerant and understanding and less likely to collect taxes on tobacco. So if you look at Kentucky and Virginia, North Carolina, Missouri, only 17 cents a pack. So the rationale for collecting an excise tax on cigarettes is that smoking causes health problems, which are expensive, and a lot of people who smoke end up on public assistance for their health care, and so the government is using the revenue from the cigarette taxes to help prop up the health care costs of people who end up using public assistance when they get sick. So that's the justification and the rationale for this particular excise tax. And so if you combine all of the excise taxes together on an average basis, this table kind of shows how much the excise taxes are on a per person basis from state to state. So you can see here in West Virginia, ours are a little bit on the high side compared to some other states. So an excise tax we've talked about is based on specific goods or services, and many of the times they're considered non-essential, or the revenues are collected to support a specific output like roadway construction or healthcare costs. Sales taxes are based on purchase of goods and services, and it used to be more common to avoid sales taxes on the internet, but now almost all purchases are subject to sales tax. And even before Amazon started collecting tax, you were supposed to report how many magazine subscriptions and online purchases and anything else that hadn't been taxed. You're supposed to report that on your income tax return in the state of West Virginia, although I don't know how many people bothered to keep track of that. But the point is that sales taxes on the internet, for a long time, the government just kind of looked the other way to try and help nurture and subsidize a new industry. But now it's becoming more common to pay sales tax regardless of who you're buying from and what state that they are based in. Property taxes are collected on real estate, buildings, big pieces of equipment like cars or construction equipment. And property taxes are collected each year independent of how much money you have or what's being done with the property. And so it's kind of an insidious thing in some cases where people will buy a home or a piece of property, and then the surrounding neighborhood gets built up, and that increases the value of what they bought a long time ago. And now suddenly they're on the hook for property taxes that are much, much higher than they're able to afford. And so some states have adopted laws that fix your property taxes so that they can't inflate over time and drown your ability to keep up with them. And California is one that's very notable. I think they call it Prop 13, where back in the 1970s they said we're going to freeze property taxes, and so as long as you live in a house, they can't go up more than just a minuscule amount every year, because things were getting really expensive in California, and people were having to sell their homes just because they couldn't afford the property tax any longer. So California dealt with it that way, and it had some side effects, but there are a lot of places that haven't dealt with it in that same way. We're pretty fortunate here in Cabell County. Property taxes are very, very low. And when I tell people friends of mine who live in other parts of the United States, they almost can't believe how cheap our property taxes are. Income taxes are applied by both the federal government and the state government, and even some local governments will collect income taxes depending on where you work and where you live. And it's based on your income, your revenue, minus deductions. And so if we had one more class meeting, then we would go specifically through kind of a lengthy activity to practice calculating income tax. But when they reduced the length of the semester from 15 weeks to 14 weeks, I figured you're going to learn about income taxes eventually on your own. So that's one of the things that I had to cut. But what we are going to do is look at property tax rates and do some calculations having to do with excise taxes. And so I'm going to start by showing you the property tax rates in Cabell County. Let me pull this up over here. All right. So here's what the web page looks like. And one of the things that's interesting is that taxes are higher in Huntington than they are in rural areas. So in the slide in just a moment, I'll show you how to use these percentages. But look at, for example, Class 2 in Huntington versus Class 2 in a rural area. Class 2, that means it's occupied by the person who owns it. So in Huntington, if you own a house, then you're paying $1.69 per $100 of assessed value. Whereas if the home is occupied by renters, then there's more tax that gets collected. And it's not the renters who pay it directly, it's the landlord. And so the landlord has to factor into the rent that they charge the idea that they're going to be paying a higher tax rate if you own a property for purposes of rental than if you own or occupy it. Okay, so the other thing I want to point out is that in the rural areas, the rates are lower than they are in Huntington. And Barbersville is even more expensive than Huntington. Of course, it's a cute little town, but it's more expensive. So you end up with your own fire department, and you end up with your own police department. You have to pay for those added services that we don't have in the unincorporated areas of Cabell County. All right, so let me pull open the in-class exercise that we're going to work on today. Since I've just showed you the property tax stuff, let's jump ahead to the second page of this in-class exercise to begin with. So the question is asking, let's assume you've got an appraised value of $200,000, and the appraised value multiplied by 0.6 gives you the assessed value. So these formulas, let me paste these formulas into the in-class exercise so we can both see it at the same time. We don't need it to be underlined though. Okay, So here's these formulas on how to figure out what is the assessed value and then how to get your property tax amount. Okay, so in a rural area, if it's owner occupied, meaning class 2, how much will the property tax be? So let me get our rural area class 2, owner occupied. Okay, so calculate that amount. How much property tax do you have to pay each year if your home's appraised value is $200,000? Let me pause for a second, let you go through those calculations. You start with this up at the top. So the appraised is $200,000, what is assessed? And then, once you know the assessed, calculate the property tax. Oh, let's see. That may have, yeah. Good point. 0.37, oh, 12, 3712, okay. Taxes went up. 3712. So, 16, oh no, taxes went down. That's not very common. 16, 45, 44. Let me double check. 200,000 and 60% of that, 1.3712 divided by 100. Yeah. All right. Ethan had it. All right. So then for the city of Huntington, all right. So any questions on how to calculate your property taxes? It's pretty strange that they have like appraised value and assessed value. It seems like it would be more natural if they just reduced the tax rate so that it could be applied to the appraised value. This multiplying by 0.6 seems like a strange, unnecessary step, but you know, whatever. All right, so that is property tax. And one of the interesting things that we can get off of this website is they say where the money goes. Let's see if they have, it used to be right on this page, but I think there's some place where it breaks down how much of the tax goes to which office. FAQ's not loading. Well, we'll skip over this question where it asks how much of that amount goes to the library. Scroll down on the FAQ page because the FAQ page isn't working. I wonder if it would come up in Chrome. Oh, estimate where your taxes will be going. Here we go. Let's just say 200,000. It doesn't really say where it goes. All right, we'll skip over that. It used to say like how much of it goes to EMS, how much goes to the library, what portion of the taxes goes to the health department, and so on and so forth. It was kind of interesting. It took the sting out of paying taxes if you saw that it was being used for something you believe in. All right, so the next thing that we will calculate is related to some sales tax calculations. So this is an actual menu that I scanned when I was at a hotel in San Diego. I was at the Omni Hotel in San Diego, and I thought it was just so ridiculous how much they were charging for stuff at that hotel that I took a photo of the menu, and then, you know, here's what they were doing is that this price was just the price for the item, but then they charged you 21% on top of it as a service fee, and then there was also a $4 guest room dining charge, and then San Diego sales tax applied on top of all the rest of that. So what is the price for a Kind Bar and a Greek yogurt? You know, you think you're skimping on breakfast and you're just going to get a granola bar and a Greek yogurt, so you're talking maybe like 300, 400 calories at best. It's a really light breakfast, but how much is it actually going to cost you once you add on the service fee, the dining charge, and sales tax on top of it? I'll give you a moment to calculate that. All right, so I've got the calculations up on the screen if you want to have a look. So you get the Kind Bar, which is $6, the Greek yogurt, which is $7. So you're looking at a combined total of $13, but then you have to add on the 21% service fee. So you're at $15.73, and then add on the $4 guest room dining charge. And I guess if they're going to charge you that, that's when you know you got to throw the yogurt on the floor that you don't eat. You know, you got to really get your money's worth out of that guest room dining charge. No, you don't do that, but it's a funny thought. So $19.73, and then you're up to 7.75% tax on top of that. So it ends up being $21.26 for a granola bar and a little cup of yogurt. Needless to say, I didn't eat in my room that day. I found someplace else for breakfast, but it's just kind of an interesting illustration of all of the add-ons that can occur just on something as simple as a granola bar and yogurt. All right, so we've got 5 minutes left, and the last thing we're going to take a look at in this in-class exercise has to do with excise taxes. And so the state puts its budget online each year. And one of the things that they identify is how much of their budget goes to transportation. So let me pull up the 2016 budget, because that's one that I already have the link to and know which page it's on. So let me bring this up. We're going to look on page 5. That's showing the state budget. And so what this is asking us is how much did the state, how much did the state spend on transportation expenditures during 2016, all categories. And so, you know, the columns are showing where the money comes from, and then the rows is showing where the expenditures go to. And so, for example, revenues across the top, this is showing that the state budget in 2016 was, I think these are thousands, and so that would have been 35 billion? Yeah, $35 billion during that year. And so the road expenditures, the revenue that comes from road-related things like the gas tax and the toll roads, they had revenues coming in of $1.1 billion, and then how much they spent, the expenditures are here on this line. So transportation, they spent $1.2 billion. And so in the in-class exercise, it's asking if you had 700,000 registered vehicles in the state, and I think that's approximately true, then how much would you have to collect per vehicle in order to cover the cost of $1.2 billion? So what we're saying is this is in thousands, and so you've got this number times 1,000 to get how much the expenditures were for revenue. So have that $1.2 billion and divide it by the number of cars on the road. 700,000 cars registered in West Virginia. So if you were going to try and collect the entire budget of the transportation department through vehicle registrations, how much would you need to collect per vehicle? Okay, so the way we do that one, let me just pull it up since we're running low on time here. It would be $1.2 billion divided by 700,000. So you'd need to have the registration fee be $1,803.31. Does anybody know what the actual registration fee is for a car? Is it $1,800?
I think last time I registered a vehicle in West Virginia was like $30 for registration. $45 maybe.
Yeah, I think they've raised it a little bit. It was $50 when I did it most recently, except for when I registered one of my cars as a hybrid. They charge extra for hybrids now because they know that they're not getting as much fuel tax out of hybrid vehicles. So, but yeah, it's certainly not $1,800. I think it's $50 for a non-hybrid and $100 for a hybrid. So, needless to say, the state isn't getting the entirety of its budget just through vehicle registration fees. It's getting some of it through gas taxes. And so now let's look at what if the excise tax was going to be collected from excise. How many cents per gallon would the state's gas tax need to be if you're collecting your needed amount of $1.2 billion and you have a population of 1,844,000 and each person is burning 458 gallons of fuel each year. So what we're going to do is we're going to find out what is the number of gallons burned each year in the state and find out how much money do we have to collect cents per gallon to generate the revenue. So let me just show you the calculation, and this will be our last thing. We know how many people there are, 1.8 million. Each person on average is using 458 gallons. So that means in the state each year there's 844 million gallons of fuel that's being burned. And so if you need to collect 1.2 billion from 844 million gallons burned, then the fuel tax would need to be $1.49 to fully fund the cost of the roads in the state. And so obviously fuel taxes aren't that high. And so the state is getting its revenue from a variety of sources for transportation costs. It's not using just any one way to do that. All right, well, that's it. We made it through the semester. You survived. As a reminder, if you haven't already, please do the course evaluations for this class in particular, but for your other classes as well. Our final exam will be on Tuesday next week, and so I'll send you a reminder about that. But if you have any questions on things as you're studying, you can give me a call on Teams or send me an email, and I'll do my best to respond. Thank you very much for a great semester. I really am in awe of you students. I think it's hard to teach remotely, but it's probably way, way worse to have to take all your classes remotely. So you've definitely earned the Iron Butt Award this semester, all just sitting in front of a screen day in and day out. I can't imagine the discipline that much must take, and so I'm really appreciative for your focus, and I know that it's been a struggle for everybody, but you've done a great job, so thanks for your attention. Hope you all do well, and hopefully I get to see you again in the future, next semester or maybe some other time. Take care, everybody.